Welcome back to The Deep Dive, the show built entirely around your sources. We strip away the market noise, cut through the hype, and focus only on the intrinsic value locked inside a company's structure and strategy. Today, we are wrestling with a firm that really defines the modern intersection of defense, technology, and critical infrastructure. Ondas Holdings, ticker ONDS.
And this is a fascinating one. We're diving into a business trading right around $9 a share. It's sitting with a substantial, and I have to say, pretty volatile market cap right now. Somewhere between, let's call it $2.89 billion and $3.34 billion as of December 6, 2025.
Yeah, and this deep dive it's unusual because ONDS isn't some mature utility company or a legacy brand we can easily value.
That's the core challenge.
Right. I mean, when we talk about value investing, especially the kind Warren Buffett preaches, we talk about a competitive moat, a durable advantage.
Of course, Coca-Cola.
Exactly. For Coke, that's brand loyalty and global distribution.
Mm-hmm.
For Ondas, the sources are all pointing to a moat built not of bricks or sugar water, but from something else entirely.
It's built from deeply entrenched regulatory approvals, proprietary wireless spectrum access, and a frankly massive geopolitical tailwind.
So our mission today is really to evaluate if ONDS has successfully made that transition. I mean, has it pivoted from a speculative small cap company, what many people call a story stock, based on promises?
And they were ridiculed for it a lot.
They were. Has it turned into a legitimately capitalized defense and infrastructure player?
And look, we can't waste time burying the lead here. Based on the numbers we have, the biggest surprise and honestly the biggest de-risking factor is that management has secured what you can only call a war chest.
It's staggering. They raised an incredible amount of capital, netting nearly $840 million in cash.
That fortress balance sheet is the pivot point. It's everything. It essentially limits the downside risk of bankruptcy to near zero for the foreseeable future. It gives them years of runway.
So they basically bought themselves time.
They bought themselves the right to execute their hypergrowth strategy without constantly, having to go back to the capital markets, cap in hand.
And hypergrowth is genuinely the operative word here. I mean, we are talking about a company that just posted a staggering, 582% year-over-year revenue growth.
582% in Q3 2025. It's a huge number.
And the market is pricing this accordingly. The stock is trading at over 22 times forward sales guidance. So the question that justifies this entire deep dive is, it's simple.
Does that make sense?
Yeah, does that hypergrowth, supported by that incredible balance sheet and the regulatory moat they've built, does it actually justify this premium valuation?
That's what we have to figure out. We need to strip away all the hype around the drone space and just methodically evaluate the intrinsic value of this enterprise, starting with what do they actually do? What do they sell?
Part 1, Chapters 1 to 3, Business Management and Financials. Chapter 1, Business Understanding.
Okay, so the first, and I think the most important step in analyzing Ondas is understanding that calling them just a drone company is a category error.
A category error. Explain that.
It's a critical distinction that most retail investors miss, and it leads to a total misvaluation. If you call Ondas a drone company, you're lumping them in with, consumer toys and hobbyist quadcopters from DJI.
But that's not what they are at all. The sources are crystal clear on this. This is an industrial infrastructure company.
Exactly. They don't just build hardware. They are building the operating system for autonomy.
And they sit at the convergence of three massive, just unstoppable secular trends. First, the essential reshoring of defense and high-tech manufacturing back to the U.S.
A huge one. Second, the automation of mission-critical infrastructure. Think rail, utilities, energy pipelines.
And third, the explosion of data-driven robotics in all kinds of industrial settings.
They are providing the essential infrastructure of autonomy. So to really grasp their strategy, we have to look at their system of systems architecture. It's integrated across three primary business units: Ondas Autonomous Systems, or OAS, then Ondas Networks, which is the legacy backbone, and then the new, highly strategic unit, Ondas Capital.
Let's unpack the growth engine first. Ondas Autonomous Systems. The OAS unit. This is where management, led by Eric Brock, executed this really smart roll-up strategy.
Right, they didn't try to invent everything from scratch, which is what kills most hardware startups.
No, they went out and they bought the best pieces.
Yeah.
They bought American Robotics for its regulatory leadership. They were pioneers in getting FAA approvals.
And then they bought Robotics for its proven, mature hardware base. That's the Israeli tech that was already working in industrial settings for years.
So let's talk about the core product that's driving all this growth in OAS. It's the Optimus system, the drone in a box.
The DIB solution. And you have to understand the huge limiting factor in industrial drone usage up to this point.
Battery life.
It's always battery life. A drone flies for maybe 30, 45 minutes, and then what happens? A human has to drive out to the field, retrieve the drone, manually swap the battery and the payload.
It's not autonomous at all.
No, it completely killed the ROI on so many of these initial pilot programs. If your autonomous system still requires a guy in a truck to go babysit the robot, you haven't really automated anything. You've just created a new, inefficient job.
So how does the Optimus system solve this?
It uses a rugged, automated airbase. You can think of it like a robotic docking station.
A little hangar for the drone.
Exactly, and it automatically opens, the drone lands itself, and the base swaps the battery, swaps the payload, say, from a thermal camera to a high-res RGB camera, and then it just relaunches it, all without any human intervention.
Now that is the key to industrial scale.
It is. One of these bases, positioned strategically, can automatically run patrols, inspections, or security monitoring across a huge area. We're talking up to 30 square miles.
And it can do that 247.
24/7. The human pilot is no longer an on-site operator. They become a remote overseer, managing a whole fleet of these things from a central command center.
That completely changes the economics. You're moving it towards a software as a service, a SaaS, margin profile.
That's the holy grail they're chasing.
Okay, so if Optimus is the eyes in the sky and the workhorse, we need to talk about the defense component, the fist, which is the Iron Drone Raider.
Right. And we know from every conflict over the past decade that just jamming a drone signal is often not enough.
Especially with sophisticated drones. They use pre-programmed GPS paths or they have highly shielded communications. You can't just jam them.
And the Iron Drone Raider addresses the single biggest vulnerability of other counter-UAS systems: collateral damage.
This is critical. I mean, think about defending an international airport or a packed stadium or, God forbid, a nuclear facility. You absolutely cannot have fragments of an explosive or large debris falling from the sky.
You can't. It's a non-starter. So the Raider solves this by being non-lethal and kinetic. It physically intercepts the hostile drone using a net and a parachute.
So it literally catches it.
It catches it and then brings it down safely. Often you can even recover it for forensic analysis to see who sent it. That controlled, non-disruptive capture is a massive differentiator for defending sensitive airspace.
And this capability is layered with the technology they acquired from Centrix, right? This creates a truly integrated layered defense system.
That's the system of systems idea. Centrix is the cyber over RF intelligence layer. It's the first line of defense.
So before you even launch the Raider.
Before you launch anything kinetic, you deploy the cyber countermeasure. The Centrix tech detects, it tracks, and it identifies the drone by analyzing its unique communication fingerprint. And then it tries to take it over.
It hacks it.
It manipulates its communication protocols to seize control and force a safe landing.
So the kill chain is comprehensive, and it's escalation friendly. You detect the threat, you track it, you attempt a cyber takeover for a safe capture.
And if that drone is hardened against a cyber attack,
then you move to kinetic interception with the Iron Drone Raider.
That's the full package. And that comprehensive offering is what allows them to approach major defense tenders as a prime contractor. They're selling an entire solution, not just a piece of hardware.
Okay, let's pivot away from that new growth engine to the legacy foundation. Ondas Networks. This is the unit that provides secure, private wireless connectivity for mission-critical infrastructure.
Primarily North American rail systems. This is the company's nervous system. It's the original business.
And this sounds like a classic value investment moat built on incredibly high switching costs.
It is. The problem they solve is fundamental. Public cellular networks, whether it's 5G or LTE, have inherent reliability issues. They're not designed for mission-critical tasks.
Right. I mean, a sudden surge in data usage, let's say 100,000 people leaving a stadium after a football game, that could overwhelm local cell towers.
And if your automated train braking system is running on that network, you could have a catastrophic failure. Same with positive train control, PTC, or signaling across a rail network. It's too risky.
So Ondas Networks provides a private, dedicated radio network.
Using a highly specialized standard, IEEE 802.16. This network is secure, it's isolated, and it's reserved only for those mission-critical operations. The moat here is enormous.
And once it's in,
Once a major Class 1 rail company invests the billions required to lay that trackside radio infrastructure, that network is locked in for 30, maybe 50 years.
okay, but I have to challenge you on that because legacy infrastructure moves slow. Why couldn't a giant like Verizon or AT&T just come in and deploy a private 5G network for them?
They could absolutely try, but they face two massive barriers. First, the regulatory and spectrum hurdles are huge, and second, the validation cost.
What do you mean by validation cost?
The rail networks require decades of proven reliability. Moving critical control functions, like braking, onto a brand new, commercially backed private network, that's a multi-billion-dollar operational risk the rail giants are simply unwilling to take.
So the switching cost isn't just financial.
It's a profound operational risk cost. So Ondas Networks is slow to build, but once it's built, it's basically a revenue annuity. It has near monopoly characteristics in its niche.
And finally, that brings us to the third leg of the stool, Ondas Capital, the strategic evolution.
This isn't just a traditional venture fund playing on the side. This is a mechanism designed to leverage the rapid, high-stakes innovation cycle that's happening globally,
Particularly in war zones.
especially in Ukraine. Management recognized the lag time in Western defense innovation. Conflict accelerates the development of disposable, highly capable, low-cost drone tech, what they call attritable systems.
So Ondas Capital's strategy is to deploy, what is it, $150 million?
$150 million to invest in and identify these battle-tested drone technologies, like a company they invested in called Rift Dynamics, and then bring that tech back to the U.S. to be manufactured under NDAA compliant standards.
It's a fast track to competitive defense technology.
Yeah.
It lets them bypass years of internal R&D.
And this is where it gets really, really interesting. The industry analysis and the sources centers on this 2025 inflection point. The era where Chinese manufacturers like DJI just dominated the commercial and municipal drone market through unbeatable prices. That's over.
It is officially over. Geopolitics and trade policy have created what our sources are calling the Great Bifurcation.
And this bifurcation is being enforced by two powerful structural walls built around the U.S. market. The first one is the regulatory wall.
Right. The U.S. and now NATO allies, they've recognized the profound national security and data sovereignty risk of having critical infrastructure or military bases relying on hardware and data storage owned or controlled by, well, non-allied nations.
This led to the creation of the DoD's Blue UAS cleared list. But in 2025, a really critical mechanism was solidified: the Green UAS certification, which is administered by AUVSI.
And this wasn't just another list. It became the mandatory official pathway for any manufacturer seeking to get on the bigger, more lucrative Blue UAS list for DoD contracts.
And this is the essence of Ondas's regulatory moat. They have been incredibly aggressive about securing these Green UAS certifications for their Optimus platforms.
Getting these certifications early, they structurally unlock billions in potential government spending. Because it just removed DJI and other non-compliant vendors from being eligible.
It's a state-enforced competitive advantage. Simple as that.
Okay, so if the regulatory wall is a slow, methodical barrier, the second wall, the tariff shock of 2025, is an immediate economic sledgehammer.
It's a sledgehammer, absolutely. The sources detail that in April of 2025, the U.S. government imposed a massive 125% reciprocal tariff on Chinese drones.
And you have to layer that on top of the existing Section 301 tariffs.
Right, so the cumulative economic burden on an imported Chinese commercial drone now sits at nearly 170%.
Let's talk about the practical impact of that for the listener. Say you own a utility company or you manage a municipal police budget. A professional-grade inspection drone that cost you, say, $2,000 to import before 2025.
With a 170% tariff, that same drone's price tag is now north of $5,000. And that's before taxes, shipping, or any dealer markup.
This is the structural shift that matters most for the commercial market. The 170% tariff artificially destroys the China price.
It completely eliminates the massive price differential that previously made Ondas's secure American and Israeli-made systems look expensive. Now, for the first time, Ondas is a competitively priced, secure option.
Even for commercial buyers who might not care about the Blue List national security mandate.
They absolutely care about their budget line items. And the sources indicate this has caused an immediate critical pivot in procurement offices all across the country.
And that leads directly to their competitive advantage, which the sources define as the moat of first. Ondas built this regulatory defensibility by being the first one to cross these critical hurdles.
The prime example is the FAA type certification for the Optimus system. And we need to be clear, this is not just a waiver. It's an extensive regulatory ordeal.
It's a huge undertaking.
It requires manufacturers to prove airworthiness, system redundancy, material safety. They have to provide mountains of operational data. It's like certifying a small manned aircraft.
And that detail is crucial. Achieving type certification grants you legal permission to operate over people and infrastructure in ways that uncertified competitors simply cannot.
Think of it as a multi-year, multi-million-dollar barrier to entry. If your competitor's starting today, you are years behind Ondas just on the paperwork alone.
Tied directly to that is their leadership in Beyond Visual Line of Sight, or BVLOS. We already established that the economics of autonomy only work if you get the pilot out of the field.
Ondas has secured these advanced BVLOS waivers, which is regulatory gold.
And that allows them to achieve that high-margin data-as-a-service profile that warrants a premium valuation. One pilot in Dallas overseeing 5 drones inspecting infrastructure in Houston, Denver, and Miami.
Exactly. What are they selling? High-resolution thermal mapping, automated leak detection, intrusion detection, all delivered immediately to the client's desktop. That is pure software margin attached to the hardware fleet deployment.
And finally, that full kill chain we talked about, detect, identify, take over, intercept, that lets them bypass the subcontractor role and bid as a prime contractor on these massive integrated national tenders.
Like border security or nationwide utility protection. They're selling a whole solution which instantly expands their total addressable market into the billions.
Chapter 2, Management Evaluation.
When you're analyzing a high-growth company in a sector, this technically complex defense robotics management is the ultimate multiplier. You have to evaluate them both as capital allocators and as operational executors.
And the source material points to a very deliberate, successful split of those roles at Ondas.
Let's start with Eric Brock, the chairman, president, and CEO. His background is highly significant here. He's not a drone engineer.
No, he's a finance guy. He spent time at Bear Stearns, Clough Capital. He fits that mold of what we call an outsider CEO.
Right. And the outsider CEO's perspective is to view the company not primarily as an R&D lab, but as a capital allocation engine.
And Brock's strategy has been defined by that. Aggressive, strategic M&A. He saw the drone market was fragmented and realized that time to market was everything.
So instead of spending 5 years trying to build a type-certified drone from scratch, he just bought the pieces. He bought the regulatory lead with American Robotics, the hardware maturity with Robotics, and the cyber capability with Centrix.
But the most defining, and I have to say the most controversial action of 2025 was the war chest decision. He engineered that massive equity raise of about $855 million.
Now, for the listener, this meant immediate, significant dilution. The share count ballooned to around 368 million shares outstanding.
And dilution is always a red flag. The market hated it at first.
Of course. But we have to view this through the lens of strategic defense. Hardware is brutally capital intensive. And in this high interest rate environment, raising debt would have been cripplingly expensive.
So that cash raise was fundamentally a survival move.
Yeah.
It was designed to avoid the valley of death that claims most venture-backed hardware startups.
I have to challenge this, though. Are you saying they diluted shareholders massively just to survive? Doesn't that sort of admit that the underlying business couldn't sustain itself, which undermines the whole growth thesis?
It's more subtle than that. They diluted shareholders to ensure execution. Think about it. Every competitor, Dragonfly, Red Cat, any small manufacturer hoping to compete in this defense boom is operating hand-to-mouth.
Okay.
Brock secured a fortress balance sheet that allows Ondas to outspend, outhire, and outweight every single rival. Securing $840 million in cash isn't just a balance sheet move, it's psychological warfare.
It allows him to negotiate from a position of absolute power, knowing he can weather any economic storm or acquisition attempt. He bought years of runway and he eliminated existential risk, which, when you're projecting $110 million in revenue, is actually accretive in the long run.
Okay, that frames the capital allocation side. Let's look at the operational excellence side, which is signaled by these strategic additions to the team. The appointment of Yoav Turgeman to the OAS Advisory Board is a massive and I think market underappreciated signal.
Turgeman is the former CEO of Rafael Advanced Defense Systems.
The Israeli defense behemoth responsible for creating the Iron Dome.
Iron Dome, the trophy active protection system. This is not just a name drop. This is a fundamental strategic pivot.
You just do not hire the former CEO of Rafael to consult on selling industrial drones to inspect water pipes.
No. His presence signals a serious, credible pivot from a commercial industrial company to a high-tier defense prime contractor. This move instantly grants ONDS the gravitas, the connections, and the understanding required to win massive, multi-year, multi-billion-dollar Ministry of Defense or Homeland Security contracts globally.
It's credibility by association. It lets them skip a decade of trying to build that defense reputation organically.
So let's discuss how they're deploying that massive cash position, their core plus strategic capital allocation strategy.
The core allocation is pretty simple. They're using capital to scale manufacturing, inventory, and sales to fulfill their rapidly growing consolidated backlog.
Which sits at $23.3 million, but it expands toward $40 million when you fully account for the recent acquisitions. And fulfilling those orders, paying suppliers, building inventory, hiring technicians, that all requires substantial working capital, which they now have in spades.
The truly fascinating part, though, is the strategic allocation through Ondas Capital, that dedicated $150 million deployment to identify and fund these dual-use technologies.
Specifically leveraging that accelerated innovation cycle coming out of global conflict zones.
And the best, most illustrative example of this strategic thinking is the $35 million investment in Performance Drone Works, or PDW.
PDW brought with it a sprawling 90,000 square foot factory in Huntsville, Alabama.
Which is the heart of U.S. defense procurement.
This is a masterstroke. Instead of spending 3 to 5 years and hundreds of millions of dollars building a factory from scratch, navigating zoning, regulatory hurdles, supply chain setup,
they efficiently secured immediate high-capacity domestic manufacturing.
That facility, which they call Drone Factory 01, is immediately capable of producing 100,000 NDA-compliant drones annually. This is the single largest de-risking factor against their operational execution threat.
It's a quick and efficient way to hedge against production hell and meet the inevitable requirements of the U.S. government, which must procure domestically manufactured hardware. Chapter 3, Financial Health.
For the first several years of its life, Ondas was a classic story stock. High potential, endless presentations, but minimal real revenue.
Q3 2025 fundamentally changes that whole narrative. Our sources confirm this quarter marks the true financial inflection point.
The headline figure, you just can't ignore it. They reported record Q3 2025 revenue of $10.1 million. That is a staggering 582% year-over-year increase compared to the $1.5 million they did in Q3 of 2024.
That exponential revenue jump is the marked validation we were all waiting for. It signals a fundamental shift in their sales cycle.
They're moving away from small, revenue-light pilot programs
to fleet deployments.
Right.
Major government contracts that involve installing dozens of Optimus systems at once.
And crucially, this volume growth is showing immediate positive impacts on their unit economics. Gross profit rose to $2.6 million, which resulted in a 26% gross margin.
Now, 26% might sound low for a tech company, but it's a massive jump from the 3% margin they posted the previous year.
3%. This margin expansion confirms the business model is working. As volume increases, the fixed costs are being absorbed, and more importantly, the higher margin software, data, and service components of the DIB system are starting to dominate the revenue mix.
And management is targeting a long-term gross margin of 50%. This jump to 26% is a massive proof point that they are on the right track to get there.
Of course, we have to acknowledge the expense side. It's still high. Cash operating expenses were up 62% to $11.6 million.
But this is understandable. You can't scale a global defense prime contractor from scratch without aggressive spending on R&D, sales force expansion, and scaling those field service teams.
And this is precisely where the balance sheet moves from just an interesting factor to the key differentiator. Let's talk about that fortress balance sheet again. After the October equity raise, the pro forma cash balance is approximately $840.4 million.
So if we look at their quarterly burn rate, their EBITDA loss, it's roughly, what, $8.76 million?
$840 million in cash gives the company a runway measured in years, not quarters.
This removes the existential risk entirely. Think about the competitive landscape again. Competitors like Dragonfly or Red Cat, they're often cash-starved, constantly under pressure to raise capital or hit aggressive short-term targets.
Ondas has the luxury of being patient. They can execute their long-term vision and even opportunistically make strategic acquisitions without that immediate fear of bankruptcy or, unfavorable capital raises.
And their debt profile is negligible. They're essentially operating with a massive negative net debt status, which is a powerful asset in this high interest rate environment. They aren't burning cash on interest payments.
So now for the valuation analysis, which is the toughest part. Since the company is still in its hyper-growth phase and it's loss-making, The PE is currently negative 22.6x. We have to look at enterprise value relative to forward sales guidance.
Okay, let's walk through it. With a market cap of about $3.34 billion, and you subtract that $840 million in net cash, you arrive at an enterprise value of approximately $2.5 billion.
And the forward guidance is the number driving this entire valuation engine. Management raised 2025 guidance to $36 million, and then they gave a preliminary but highly ambitious 2026 target of $110 million.
So if we run that calculation, $2.5 billion EV divided by $110 million in projected 2026 sales. The stock is trading at roughly 22.7 times forward sales.
Okay, that is an eye-watering multiple. I have to push back here. 22 times forward sales is the kind of multiple you might give to a pure-play, high-margin SaaS company. How can a business that still has hardware components and logistical risk justify that kind of premium?
That is the critical debate, and the justification lies entirely in the moat. Defense primes, for example, typically trade between 2x and 5x sales. High-growth industrial companies might trade between 6x and 10x.
Ondas is arguing they deserve a SaaS multiple because the hardware is just the loss leader. It's the gateway to a recurring, high-margin, regulatory-mandated data-as-a-service revenue stream.
So investors are paying for the future 50% gross margin business, not the current 26% margin business.
Precisely. They are paying a premium for the monopoly characteristics created by the regulatory walls and the tariffs. Very few companies can service the NDAA-compliant BVLOS type certified market. When you have a near monopoly in a mandated critical infrastructure sector, the market tends to award that premium multiple.
And the 582% year-over-year growth acts as the validation that this narrative is materializing right now.
We also have to apply a sum-of-the-parts approach here. That $2.5 billion EV doesn't fully capture two key components. First, the inherent value of the proprietary spectrum held by Ondas networks that secure sticky rail infrastructure business. It acts as a foundational, stable revenue base.
And second,
The embedded optionality of Ondas Capital. You're not just buying the current drone business, you're buying a strategic portfolio of future growth options.
So?
That $35 million investment in PDW, for instance, if that Huntsville factory helps Ondas secure a massive, multi-billion-dollar border security contract, the long-term return on that $35 million could be immense.
the optionality in their combat-proven tech pipeline is intangible but huge. Like and subscribe to Stock Analytics AI.
For $4.99 a month, get 500-plus deep dive videos on all S&P 500 stocks, with NASDAQ 100 coming next, plus members-only requested deep dives.
Part 2, Chapters 4 to 7, Market Sentiment, Ownership, Risk, and Final Conclusion. Chapter 4, Market Sentiment.
Moving into December 2025, the market mood surrounding Ondas is, well, it's decidedly bullish. Our sources indicate a sentiment bordering on euphoric.
It's being driven by those positive financial catalysts and the recent volatility that has just propelled the stock higher throughout the fourth quarter. It's a classic Santa Claus rally, but this one is driven by material facts.
And we are seeing what analysts call the street chasing the story, which is a key sign that the narrative has finally truly shifted. That massive capital raise and the Q3 results confirming the 582% growth have prompted a rush of analyst upgrades.
Yeah, we saw Oppenheimer upgrading them to outperform with a $12 target. Lake Street raised their target to $10, and H.C. Wainwright initiated coverage with a buy and a $12 target.
So the consensus price target is now sitting north of $11, which implies significant near-term upside from the current $9 level.
The narrative shift is complete. It's highly visible. Investors no longer see a speculative R&D company. They see a defense prime in the making.
And it's driven by all the buzzwords that command high multiples. Autonomous border protection, counter-UAS capabilities, and, most crucially, NDAA compliant.
We should also look at the technical strengths supporting this sentiment. The stock is trading significantly above its key moving averages. The 50-day is comfortably at $7.72, and the 200-day is way down at $4.68.
That confirms a strong, sustained, long-term uptrend. This isn't just a flash in the pan. The market recognized this inflection point months ago, probably signaled by a golden cross, and institutional capital has been flowing in ever since, solidifying this bull run.
And we can't ignore the macro tailwinds here. The Federal Reserve's policy decisions are remarkably supportive of growth stocks right now.
That's right. Markets are anticipating a rate cut in December 2025, with something like an 87% probability of a 25 basis point reduction.
This is critical for high-duration assets like Ondas. Lower interest rates increase the present value of all those massive future cash flows they're projecting for 2026 and beyond. It just makes the company more valuable today.
And a lower rate environment can weaken the US dollar, which supports international sales for their high-tech defense products in Europe and other NATO countries.
Chapter 5. Ownership structure.
The quality and stability of the shareholder base is a silent component of intrinsic value. And we've seen this massive stabilizing transformation in Ondas's ownership structure in 2025.
It's transitioned from a volatile, retail-heavy float to one that is now dominated by major institutional support.
The Q3 2025 institutional filings are incredibly revealing. They tell the story of smart money moving in once the risk was defanged by that cash raise and the revenue validation.
And the entry of Renaissance Technologies, Rentech, the legendary quant fund, that is the biggest signal of all.
They opened a significant new position of about 8.3 million shares. And you have to remember, quant funds do not invest based on CEO interviews or stories. They invest based on proprietary, sophisticated statistical signals.
So their entry strongly suggests that their algorithms detected a hard, quantifiable inflection point in the company's fundamentals that validates this whole narrative.
And Rentech isn't alone in their conviction. Hood River Capital Management, already a top holder, increased their position by a staggering 113% to about 16.1 million shares.
That is high conviction buying from specialized small cap managers who believe in this long-term growth trajectory.
We also gain a lot of stability from the presence of the passive floors, Vanguard and BlackRock. They collectively hold nearly 18.4 million shares.
And these holdings provide inherent liquidity and structural buying pressure. As Ondas's market cap grows and it gets included in more indices, these giants are forced to buy consistently, which ensures a floor for the stock price.
Let's revisit the insider activity, because that always raises questions after a major run-up like this. You look for management cashing out, signaling a top.
Right, and we did see Director Ron Stern sell about 850,000 shares in November, but this is typically viewed as just monetizing stock options or compensation. It's common after a rally.
Critically, we see stability and alignment from CEO Eric Brock. His compensation structure is tied explicitly to long-term performance metrics. This reinforces his empire-building mentality, not a short-term pump and dump.
And finally, let's revisit the dilution reality one last time. The share count did balloon to about 368 million. However, the consensus of the sources is that this dilution was entirely accretive.
Right. The $855 million in capital they raised fundamentally added more net enterprise value and security than the dilution subtracted. And the proof is that the company still commands a $3 billion plus market cap.
They bought growth, they bought market dominance, and they bought survival at a crucial turning point. The institutions agree, which is why they piled in right after the raise. Chapter 6. Risk Assessment.
Okay, before we get to the final conclusion, a proper deep dive requires a rigorous, candid review of the risks. So let's summarize with a high-level SWOT analysis from the source material.
The strengths are clear. The regulatory moat, that massive $840 million balance sheet, and the highly defensible full kill chain technology.
The opportunities are equally immense. You've got the 170% Chinese tariff wall acting as a barrier for competitors, and the global defense spending increase driven by geopolitical instability.
But the weaknesses are profound, and they have to be managed. The company is still burning cash. We estimated about $8 to $12 million a quarter, and net income is still negative.
And there's also the enormous complexity of integrating multiple acquired technologies. You have Israeli hardware, American regulatory systems, specialized cyber software, making that all one coherent, reliable, mission-critical system. It's not easy.
That integration risk is a massive point. I mean, if you take hardware from Robotics, software from Centrix, and the BVLOS framework from American Robotics, and you try to make them all talk to each other seamlessly under defense standards, that sounds like a recipe for implementation hell. How do they mitigate that?
And that leads directly to the primary internal threat, execution risk. The biggest threat to Ondas is not the competition. It's the risk of not hitting their ambitious $110 million 2026 revenue target.
This requires a massive, flawless ramp-up in manufacturing, logistics, and supply chain management. If they fail to execute on the backlog, that premium valuation vanishes overnight.
This is why that external tailwind, the 170% tariff, is so important. It buys them time and it locks out competitors, but it doesn't solve their internal manufacturing challenges.
No, the tariffs are the safety net. That trade policy acts as a powerful economic wind, destroying the China price and forcing the entire U.S. commercial, municipal, and government market to pivot immediately to NDAA-compliant systems. This massive, sudden increase in demand puts extreme pressure on domestic producers like Ondas.
So if execution risk is the biggest threat, this valley of implementation, What is the primary mitigation strategy management has put in place?
It's the strategic investment in PDW and that Huntsville factory. That facility is their crucial hedge against supply chain failure.
By leveraging existing high-capacity domestic facilities that are already compliant with strict military and security manufacturing standards, they get to bypass years of construction and supply chain validation.
The ability to produce 100,000 units annually in the U.S. instantly alleviates the pressure of scaling from scratch. Any supply chain hiccup, a chip delay, a motor shortage is the one factor that could instantly punish the stock's premium valuation. They are betting $35 million on PDW to avoid that fate. Chapter 7. Conclusion.
So bringing it all together, Ondas Holdings represents a unique, almost oxymoronic public venture value proposition in the current public markets.
What you're buying is a portfolio of strategic assets, validated regulatory approvals, proprietary spectrum access, and combat-proven technology, all managed by a skilled capital allocator in Eric Brock.
The intrinsic value of this company really rests on three fundamental pillars, and these are why the stock deserves a closer look, even with that premium multiple.
The first pillar is the floor. The massive $840 million in cash provides a hard floor. It virtually eliminates the downside risk of bankruptcy or some kind of emergency dilutive financing.
The company is trading at roughly 3.5 times its cash position, which provides significant stability in this very volatile small-cap world.
The second is the growth. That exponential 582% year-over-year revenue increase validates their product-market fit. The regulatory moat they built means the world is forced to move toward autonomous security solutions, and Ondas has the first certified comprehensive solution to deliver it.
And the third pillar is the option. The Ondas Capital unit, with its $150 million dedicated to strategic defense and dual-use tech, provides embedded optionality. If those investments in combat-proven tech succeed and scale to the domestic market via the Huntsville factory, the potential returns could be astronomical.
So let's synthesize the valuation. The stock is currently trading around $9. Analyst consensus is above 11. It's trading at a rich 22.7 times forward sales.
Our verdict is that the stock is unequivocally priced for growth. But for the first time in the company's existence, that growth is actively, tangibly, and institutionally materializing through contract wins and those validated Q3 financials.
Therefore, our outlook is a buy with a seatbelt. Ondas passes the crucial test of having a real defensible moat enforced by powerful regulation and economic tariffs. And management has proven their ability to allocate capital strategically.
But investors need to be prepared for the volatility inherent in a headline-driven small-cap sector. The 3 to 5 year structural trend, however, favors the company that is building the critical infrastructure for autonomous systems.
And here's the provocative final thought for you to consider as you wrap up this deep dive. Ondas has developed two primary non-disruptive methods for dealing with hostile drones. The Iron Drone Raider uses controlled kinetic capture with a net, and Centrix uses cyber takeover to land it safely.
So which one defines the future of security procurement? When governments and critical infrastructure face a drone threat, they have to choose between disruptive methods like jamming signals, which is highly disruptive to civilian communications, and GPS versus non-lethal, precise takeover and physical capture.
The ability to neutralize a threat without creating collateral damage or disrupting civil life. That is what truly unlocks the multi-billion-dollar homeland security market.
And Ondas is betting that control and precision will ultimately supersede disruptive jamming as the required industry standard.
Like and subscribe to Stock Analytics AI.
The discussion today was based purely on the analysis of provided source material as of December 6, 2025, and does not constitute financial or investment advice.
Our analysis was assisted by AI research. We always encourage you to do your own thorough due diligence and research before making any investment decisions. Thank you for joining the deep dive.